here we have accumulation on the pound futures via a daily time frame. This is still cause and effect. Trading ranges, as we know, builds cause. And this leads us to probably the most famous works of Wyckoff, and that is the process of accumulation and distribution. These are the Mac Daddy of trading ranges, the largest, the biggest, and they can go on for years. Now, there are literally hundreds of examples of accumulation of this process peppered all over the internet, and I too could spend a few hours on the subject. However, there is no need. I will illustrate what is of value and practical. And all we really need to do is to be able to recognize the behavior and understand what exactly is occurring. Before we begin, we must understand that the markets are controlled, manipulated by groups of people. In VSA terms, it's called the smart money. Wyckoff called it the composite operator, which embodies all market participants. As Wyckoff stated, here's a quote, that the market is made by the mind of man, and all the fluctuations of the market and all the various stocks should be studied as if they were the result of one man's operation. Let us call him the composite operator, who in theory sits behind the scenes and plays a stock to his advantage. Now, from a personal stance, it's all of the above and more. I like to think in layman's terms. It's just that it's the large interests. I call them the well-funded, the investment trusts, banks, specialists, syndicates, hedge funds, whatever. Because we never know whom exactly is in control, as certain groups or funds may only specialise in 4 stocks, and some will work together on a campaign. And to be honest, we don't need to know. All we do need to know is to be able to recognise behaviour. And we do this by analysing the humble bar and volume relationship. It's the footprint they leave behind, as they are the driving force behind the bars. The larger interests are the volume, and they create the cause within the trading range. There is a Wyckoffia model, a very basic model, which comprises of 4 phases. I'm sure you are familiar. I will just go through very quickly. We have accumulation, which is where the larger interests collect or aggregate stock. They buy stock and eradicate supply. And then the movement up is called markup. And then we have distribution, where the larger interests eradicate their longs and they short the position. They expect prices to go down. Then we get markdown and back to accumulation. Of course, along the way you may have reaccumulation or redistribution, but again, it doesn't help us. Let's talk about accumulation. This is the basic 4 phases: accumulation, markup, distribution, markdown, and then we come back to accumulation again. This is very, very basic. And if we reflect back to the cause and effect, accumulation is the cause, and the markup is the effect. Distribution is the cause, and the markdown, our downtrend, is the effect. Okay, so they are synced. Anyhow, accumulation is the process where the group, the well-funded or called the strong hands, they acquire large quantities of stock. And this process is manipulated. It's thought out, it's well planned, and it takes advantage of the retail trader. And the purpose is to absorb as much of the floating stock as possible. And once their inventory is full, they will begin markup. They take advantage or on occasion manipulate the retail trader and other non-informed traders, as in the weak hands, by fear, by forms of media, earning reports, or they leak unfavourable news about a company, etc. And this forces the weak hands to sell, and the strong hands, well funded, are more than happy to buy. Again, we don't need to know all the ins and outs. Why? Because we can see the action on a chart. We just need to understand and recognise the behaviour. The strong hands absorb as much as possible before markup in the accumulation phase. So there is less friction to the upside, which is less selling. If there is a lack of selling pressure in the market, it will take very little force, which is volume buying, to drive the market higher. Now don't forget that they own much of the floating supply of stock, so they are making substantial profits. This whole process, they call it a campaign. They will have areas of price that they are willing to buy at for whatever reason, whatever they see fit. And this is known well in advance. And when it comes to this area, they buy, and they soak it all up. Accumulation via the chart takes place in a prolonged trading range. Sideways movement that can last years via a daily chart and as little as 90 minutes via a 5-minute chart. The pattern and process occurs on all time frames. There are a few characteristics that fortunately to the trained eye are fairly easily to identify, and that's where we're going to spend our attention. And the main ingredient is climactic action. In accumulation, this would be in the form of a selling climax. The bar will have ultra high volume with an ultra wide spread closing off the lows. And this must occur in a mature trend, one that is long in the tooth right at the end, and often breaks a channel if applicable. And the price action tends to literally drop out of bed. It falls too fast too soon. It's parabolic in nature. So let me give you an example here. So the climactic bar would be as follows. So we'd be coming down with spreads like this. And let's just say there's more bars and we've been coming down for 2 years. And volume is like this. Then all of a sudden we'll have a bar that may print like this. It can be 10, 12 times the size of an average spread, and the volume will be like this. Again, it could be 5, 6, 7, 8, 10 times the size. So we'd call this an ultra wide spread and an ultra high volume. And the bar, you cannot not notice the bar. It's like the polar bear in the desert. It falls too fast, too soon. Okay, you will be able to spot this bar a mile off. And this is very important. This is our selling climax bar. Now, it has to be contextually correct. We have to be in a downtrend that is fairly long in the tooth. We wouldn't, if we come up like this, and then we have this bar here, and we close like this with still good volume, we'd think this would be a shakeout. We wouldn't class that as a selling climax because it has to be at the end of a trend. Alternatively, if we're in the trading range and we have spreads like this and we get a large one like this, again, we wouldn't classify this as a selling climax. Why? Because we're not at the end of a downtrend. This is quite mechanical in a way. It has to have certain market conditions, context, or in the background to make it a selling climax. So for the bar to be a selling climax, we need to be 1, in a downtrend. 2, ultra wide spread. At 3, ultra high volume. And we want to see we want the downtrend to be old in the tooth. It's got to be an established trend, okay? And it also has to be contextually correct, not in the middle of a trading range, etc., etc., or surrounded by other widespread high volume bars. Okay, you will be able to spot them. I do have various studies of climactic bars on the website. Please feel free to look through them. I don't want to put filler in this course because I don't really use this form of Wyckofian logic. And on this chart, it's represented by this widespread and this high volume. This is what we call a selling climax, a huge. So we have a trend here, a little trend, but bear in mind for context, we've been coming down since 2014. And this is October 2017. So we've been in a very, very large downtrend. And from this mini channel, we have this bar, closes well off the lows with extremely high volume. Okay, and this would be our selling climax bar. You can see that the spread and the volume, so everything around here is 3, 4, 5 times the size and at least double the volume. And we close off the lows. And that is our selling climax bar. Next is an automatic rally. Now these, which is here. Now these are interesting. Due to the extremity of the selling climax, it creates a vacuum within the market, a slight imbalance, and this is resolved by an automatic rally. The vacuum is created due to the selling climax bar. The ultra widespread high volume bar, it chunks at price and takes huge bites out of the market, fulfilling huge orders very, very quickly. And this creates a vacuum. In other words, a space in the market. It creates an imbalance between the forces of demand and supply. And this is resolved by the automatic rally. You will usually see a few up bars. We don't see this here actually, but you usually see a few up bars in a row. But this is an automatic rally. The climactic bar is a frenzy. It's coming down hard. It's very aggressive, chunking at price, taking huge orders out of the market. It disrupts the flow, hence the automatic rally. Okay, the automatic rally, think about it, there's no more selling pressure in the market. All orders have been eradicated. So we can literally push up the market with very, very, very little force. So with an automatic rally, there's nothing to do. We just literally put it on the watch list. Why? Well, if we can spot it's an automatic rally, which is very hard to do. We don't really know its accumulation to the secondary test. Accumulation process can go on literally for years or months, depending on the time frame. And we don't want to tie up our money with something trading sideways. We're missing out on potential moves in other markets. Let me just give you a visual representation of what's occurring. When we come down on a selling climax bar, it's chunking at price. We're in a frenzy, and there are large orders being fulfilled, and this creates space in the market. So once all the selling and buying and backwards and forwards are stopped, literally we can just rise like this, and this will be our automatic rally. It fulfills the imbalance between the forces of demand and supply, especially if it's very aggressive with ultra high volume and an extremely wide spread. Secondary tests. The nature of a secondary test is to probe for supply. Why? Well, before markup can begin, they test the market for supply. Don't forget our little Wyckofian model. We have our trading range, which is accumulation, And then we have markup here, just say MU. Then we have distribution. And then we have markdown. So at the moment, we're in the accumulation phase. And the point of the secondary test is to probe to make sure there's no more supply before we go into markup. Why? Because if there's supply left in the market, they have to absorb the supply. They have to absorb the selling, which of course costs them money. So the testing, the probing, is testing for supply. And they do this by either withdrawing from the market, as in there's no activity for say from here, they withdraw from the market, they let price, the retail, take over, and just to see how much supply is left in the market. Or alternatively, if there's a high volume supply bar to the left, say there's a high volume supply bar here, they will bring it down just to make sure there's no more selling here. Why? Because because they don't want any selling pressure or any selling activity through markup, again because they have to absorb all that selling pressure, which costs them money. I mean, this action, this testing action, is very frequent in the markets, and most high volume bars are tested in one way or another, and dependent on the amount of supply in the market depends on the amount of secondary tests. Hence, there is no finite number I can give, but however, from experience, or my experience, a ballpark figure from accumulation, I would say, is from 2 to 6 secondary tests. Okay, usually 2 to 6. Now, please don't take this as written in stone, but from my personal experience, I've been dealing with accumulation for years and years and traded many different types of accumulation, because they all have their different flavors. Secondary tests usually between 2 and 6. Now, the secondary tests themselves, again, they come in a variety, and these can be either a shakeout, bag holding, springs, or literally a test, which is a weak pullback into a high volume bar / area. So we come up, 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 and then we have a big widespread bar. Not climactic, just a big widespread with good volume, but good flow to the upside. We'd call this good quality buying. So we might get shortening of the thrust, and then we might come down, not particularly strong. And we'll either dip to the highs of the bar, say here, or the close for testing. Usually test at the high or the close of a high volume bar. Alternatively, as a last resort, it will be the 50% area of the bar. So let me repeat that. It's very important to recognize that with high volume bars, they would like to test either the highs. This is in general, not just in accumulation. They'll either test the highs, the close, or if it is a widespread with very good volume, the 50% rule. Wyckoff used to like the 50% rule, and to be fair, from my experience, it does hold up well. That's the only percentage I use, is the 50% rule for retracements into high volume bars. A shakeout is a secondary test, and it's designed to get rid of premature longs. Traders who are already long, the strong hands do not want people riding on their coattails, so they slam it down, and this takes effort, as in contracts, which is of course volume, and they will know where the stops are. They know how the retail trader thinks, and they want their contracts. So when these stops are triggered, the strong hands buy. So it acts as so they get twice the amount of benefit from a shakeout. A, it gets rid of weak longs, and B, sometimes shakeouts can induce bear traps where there's many stops. So every time this is triggering sell orders for breakout traders, say under a resistance, they're buying. Hence we get high volume. Okay. Now there are characteristics of shakeouts, and we do study them in depth at a later date, so I won't spend that much time on them now. I think that's coming in session 6, but I will continue here. A shakeout more often than not has a quick recovery and drives up strong, as the shakeout itself traps the bears and they can't escape. So as we move higher, all the bears will begin to liquidate for loss, which will of course increase upside momentum, which is why we get good ease of movement and strong bars. This process adds more fuel, increases the force of buying. Bag holding is a secondary test, and it's very rare, yet very powerful. It has ultra high volume, very narrow spread, usually at support, and will halt a down move, and usually occurs towards the end of accumulation. If we have established accumulation, which is buying, in the background, and we react to test support and price halts with a narrow spread and ultra high volume, our ears must perk. This action is eradicating a huge amount of supply in one bar. For every sell order that comes in, they match it with a buy order, and they continue to do this for the whole bar. Hence, with very high volume, there is very little movement, ergo the narrow spread. And it is a very blatant manipulation, and often higher prices are on the cards pretty soon. It's almost as if they've had enough and it's the final move before markup. Just think about this. Bag holding occurs on a daily time frame. So if we have, say this is average volume, and then we get a bar like this, volume like this, and then this is average spreads, and then we have a bar like this and a spread like this, and this occurs over one day. So we've got 4x the volume, and our spread is 5 times smaller than average. Think how orchestrated this bag holding bar is. For every sell order that is coming in, it's matched instantly with a buy order. Hence, there's no real movement in the bar, and it's incredible when you think deep. When you think deep about the mechanics of a bag holding bar, it's genius, really. It truly is genius. And bag holding on a daily chart is usually associated with very bad news. Why? Well, to get the public selling. And of course, the strong hands, clever in what they do, they will just buy all those sell orders as they come in instantly. Okay? Now, bag holding is a concept or a principle that can occur on all time frames. And I have to point this out, and on more than one bar. I am primarily an intraday trader, and I do see this occur probably weekly, or I couldn't give an exact, but a few times a month. And all we do is we'll see price come down, normal spreads, and then we might get a couple of just small spreads, say 50% smaller. As we're coming down, we'll have a volume like this, but the volume may not be overt, but it'll be high. We might get 2 or possibly 3 bars, 3 narrow bars with very high volume. This is still bag holding, but occurring over 3 bars. Why? Well, if you think of the spreads, all the spreads are the same, so there's no progress that's been made up or down. So the spread is this, but if we combine the volume, we have volume this high for this spread. And why would this occur? Well, some stocks are manipulated by different people, different funds, different players, and perhaps one bar with one ultra high volume is too blatant for one manipulator, so they will just put it over 3 or 2 bars. Okay, it's a less blatant approach, but it achieves the same thing, and the principle remains the same. And I just thought I should share that with you because it's it's a very good trade setup. Okay, spring is a secondary test, and all this is, so this is support. You dip under all the price action at support to reverse and close firm. As we dip under, firms no further selling, no supply to reverse and close firm. And this is a good sign of strength bar. It's a very powerful bar that is used, and I'm sure you know by now, very much in our methodology. I won't go too much into springs. This is it in the basic. Why? Because we spend a great deal of time on springs in depth, in its entirety, next session. Again, with all concepts for my secondary tests, shakeouts, bag holding, springs. We will go into depth with these next session. Okay? After these secondary tests have concluded and the strong hands have filled their inventory and happy that enough supply has been absorbed, which is the purpose of the secondary test, to probe for supply, the market will produce a sign of strength, which is a solid move. It can be a superb demand bar or drive up in successive bars that breaks resistance, like this is our sign of strength bar. This action indicates we are more or less ready to start markup, and for all intents and purposes, resistance in Wyckoff terms is known as the creek. You may have heard of this. And support is known as ice. And there are setups known as the backup to the edge of the creek, called the Bowick. I'm not sure how you pronounce that. And we have a setup which is called the rally back to ice. Or, yeah, rally back to ice. These abstract, obscure names were stories that originated by Bob Evans in the 50s or 60s. He was a great Wyckoff trader, and he took over the works of Wyckoff, and he produced these little stories to help solidify the concepts. Now, I won't go into the stories. What we need to know is that resistance is called the creek and support is called the ice. And we have a setup called the backup to the edge of the creek and a setup called the rally back to ice. And we will discuss these setups later in this session. Please bear in mind that I have stripped back accumulation to the bones. I mean, there are phases which we can dissect and break into, and to be honest, it doesn't offer an edge, not one that I can see. I mean, what's important is to recognise the core principles we've just gone through: the selling climax, the automatic rally, the secondary tests and their purpose, so you can see that supply is eradicating, and types of secondary tests are springs, shakeouts and bag holding, etc. And importantly, the sign of strength. I mean, the safest way to trade accumulation is the backup to the edge of the creek. Why? Because we never can really know how long accumulation can last, and we don't want our money tied up unnecessarily. Let's put our newfound knowledge into practice, and this is how I would dissect accumulation. And just to ground ourselves, this is a daily chart, and for context purposes, we've been in a downtrend since mid-2014, and I think we were trading around 1700-ish, which is literally 5,000 ticks away. So suffice to say that we have been in a very good downtrend for nearly 3 years. The first thing I do is, say we're coming fresh to this chart, is to keep it simple. Then the number one thing I do is I will notice this ultra wide spread with high volume that falls out of bed, that closes firm. And I would instantly be thinking that I would instantly recognize that as a selling climax bar. And the first thing you do is always draw support in from the low. I cannot stress this important enough. This is an area that the market respects. It is a very important level. Don't get me wrong, it doesn't always pan out. We can drift a little lower. However, it is advisable to always draw this level in, as the market does respect this level. So that's the first thing we'll do, is to draw in support from here. Now, if we take a macro perspective, when we've come into this chart, what do we notice? Well, I notice buying. I notice buying. I notice good buying. 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 Suffice to say, there's good buying all over this chart. And then, well, I see a little bit of selling here, a little bit of selling here. To be expected. Why? Because we're at resistance, and we do get some good selling there. But then what happens? The selling force has gone. Spreads have narrowed. Volume has declined, as we can see. And here we're at resistance. We get some selling. Then what happens? We don't even react. We hold. So just from this brief macro perspective, we have already dissected this chart very, very quickly. We have noted buying all along the lows. And when we look for selling, there is no follow through. So here we kind of round under, shortening of the thrust. Here we don't even react. We hold after good buying. So we have buying of good quality with wide spreads. Then we have poor quality selling. And that's it. Very, very simple. We don't need to analyze bar by bar. I like to say this, but it's like hitting our head against a brick wall. This is clear as day that buying is emerging at support here and this local level after a selling climax. And that's it. That's all we need to do. This is the way that I would analyze the chart. Coming into it fresh, again, buying all over the place, and then I'd analyse the selling, and we've already noted that the selling is poor in comparison to the buying. Then I will go into a little bit more detail. So this is exactly how I'd analyse. First of all, we just noted the buying, and then the selling we round under, no supply, and then we have selling, and then we hold. So the selling force really has dried up. But now we look into the buying bars, and what do we know? The buying bars have the high volume. So this is buying of good quality, confirmed by the force, volume. And what do we know about these two bars? Very narrow bars with high volume, holding support, refusing to go lower. This is bag holding. We just spoke about this previously. So if we see this action, do not hesitate, just buy. And your stop would have to go under either the support level or any price of the lows of any price action, which would be here. Now I would go into more detail. So this is a selling climax bar. And it's a classic example. We can draw in a little structure. We slam down out of our channel, ultra wide spread, ultra high volume, that closes off the lows. The move is parabolic as we break the channel and we fall too fast too soon. Now just to make this clear, although this is climactic action and would have been noted, experienced traders wouldn't have known that this is actually accumulation until ST1. 80% sure this is accumulation. By ST2, I'm 99% sure. I'm just sharing that with you for disclosure purposes. Even experienced Wyckoff traders would not really know until ST1, ST2 that this would be accumulation. Anyhow, from the semi-climax, we have clear evidence of buying at this bar. Here, good volume and good spread. And we would think that this bar would take off. Why? Well, what does it achieve? Well, we break this little local resistance with a wide spread and good volume, and we close above the selling climax close. And don't forget, we said that from a selling or an ultra wide spread bar with high volume, we would always draw in levels from the support, the low, the high, and the close. We have to draw in those levels because the market, for whatever reason, respects these areas, and we push up and close above the close and this local level. So from here, I would expect higher prices, and there's nothing wrong with thinking that. We don't know, if we're live in front of the markets and we see this, we don't know that that is an actual selling climax. It has the potential to be a selling climax, and I would note that that's buying coming in, and then here I can see buying here and buying here. So why not take off? The point being is we don't always get accumulation in the Wyckofian sense from a climactic bar like this. Okay, we can call it a selling climax or a climactic bar. We don't always get the automatic rally or the secondary test after a selling climax, and that's very important. This could be a mere demand zone, or the selling climax could be some sort of stopping action. Although technically a buying zone is accumulation of sorts, it's not the Wyckofian elongated selling climax, automatic rally, ST1, secondary test, sign of strength, last point of support, etc., and then we break through. That's important to note because we've got many examples later on in this session where a selling climax does not result in Wyckofian accumulation. And ST1. What do we note? Lovely spring. It dips under the selling climax bar to reverse and close firm above these closes, these lows, and back above this support and this local level of support with a surge in volume. So this bar accomplishes a great deal. Now there's the big subtlety here that I would like to share with you, which is very, very interesting. Now, these two bars here, they come down and we increase in volume. Then we get to this area here, the support, and what happens? Volume declines and rounds under. Then as we rally, demand increases. So what's going on here? Well, these two bars have been pushed down by the large operators, and this has cost them contracts, and they want to push it down to either A, obtain more contracts, or B, just to give the market momentum so it can fall down naturally from the retail. Okay, they want to see how much supply is in this area, and they want to accumulate contracts. And sometimes the market will not fall, and they have to induce the market. They have to tempt the market into lower prices, and they do this by selling, and the momentum will carry it further. Isn't that interesting? So these two bars, they increase. We get to this level here, we decrease in round under with no selling. And then as we rally, we increase again. Fascinating behavior. So when we get to S1, when we know there's no supply, because we can see it here, this move is engineered. So the spring is forced down under here, induces some selling, probably hits some stops, and we know it does due to the volume, and then reverses to close firm and catches traders off guard. Acts as a bear trap and they gain additional contracts. Very, very good trading. And this leads to ST2. Very strong bar. It acts as a spring. It's a bit too close to be a spring, but it is spring in action. We dip under all the price action. Reverse to close extremely firm at the highs, wiping out all this price action to the left. Close above this level here, and we do so on higher volume than the selling climax, which is actually pretty rare. But just imagine this. Imagine people who could recognize this spring and they put their stop here. This catches this, gets rid of weak longs and kind of acts like a shakeout, but also springs. So it's a very, very clever bar. This would catch many traders off guard. And then boom, reverse to close firm, getting rid of weak longs and also inducing a bear trap. And that is buying in a big way. That is extremely high volume. So there can be no doubts that by the close of this bar, with all this price action behind us, that this is accumulating. I mean, this is strength. No two ways about it. However, the volume is large, and we know that high volume bars do like to be tested. The markets always like to test high volume bars. So although demand wins this battle, clearly, there is still supply in this bar, and they need to make sure. Well, how do you know? Well, because it takes effort to drive it down in the first place. Okay? That takes selling. And they need to make sure that in this high volume, there is no supply before they mark up and move on to higher prices. And then we come to ST3. Bag holding. We come back to test right at support. The two narrow bars with high volume. And the second bar here is even narrower than the first bar with even higher volume and closes above the previous close. The subtleties are astounding. Every sell order is matched with a buy order literally as they come in. Price appears stagnant. You know, it doesn't move. Bag holding is a big personal favourite as it is often not tested and occurs at support, clear as day. So this is a subtle hint, or I should say a big hint to me, from the strong hands that the market is about to move. Usually, because it is so blatant, it's the final action. And as we can see here, we never look back. And this leads to the sign of strength bar. It's a good demand bar, as we can see from the widespread closes firm, good surge in volume, and it must close above resistance, which of course is the creek. Now I can see this dotted lines here and here. These are, I would have to, or these were on my chart, and I would have these levels in. We can see 1, 2, 3, 4, you know, it is respected here, 1, 2, 3, 4. So these levels would be drawn in. This is where it becomes a little tricky. This, as I said, the sign of strength should be a good strong bar that breaks resistance, which is also known now as the creek. And resistance, as we know, is horizontal, whereas the creek in pure Wyckoffean terms kind of follows the price action like so, and this would be our resistance, also known as the creek. This I find one of the most non-linear aspects of Wyckoff. But it does make sense, but for my analysis, I only use the horizontal. I mean, you can draw it. The best way to draw it is just kind of follow ever so slightly the swing highs, and that is known as the creek. But it is very difficult to draw. It requires the greatest artistic license of all Wyckoffean structure applications, and it is a very unusual concept, and I have seen it work, mind you, and it does get you in a little earlier, because as you can see here, when we close firm across this area with this strong bar, it gets you in a little earlier. But I like to trade the way where everyone sees what's in the market. And I don't think everyone will see the creek. I believe most people will be watching the horizontal resistance. And for that reason, and that reason alone, apart from I can't draw the creek myself in the same way, is why I just discard this. I've never used it. But I want to make you aware that this is a possibility and is the purest Wyckoffean way. As you know, I have cherry-picked the most potent concepts and principles, and the creek, as nice as it looks, doesn't offer an additional edge. It's hard to applicate, and I believe that everyone just sees the horizontal resistance. Okay? To finish on the sign of strength, this is the very confirmation, this bar, that we need to know that we are done with accumulating and now higher prices are on the cards. This is the final piece of the jigsaw right here, the sign of strength bar. And this is picture perfect in every way. Now, if you notice, there is LPS, which is the last point of support. And again, this is unused from my perspective. I've never used. Again, I've added the LPS to make you aware. I mean, the only reason I've included LPS is that when we get a backup to the edge of the creek setup, so when we break here and then we come back to test newly formed, as this was resistance, should now be support. So as we break from the sign of strength and come back to test this level, my stop, if there is an LPS, would go under. And that is it. It can be placed under the LPS. Why? Well, price rarely, if ever, has broken this level for my personal trading. And that is it. LPS, apart from for stock placement, serves no purpose, does not offer anything of value. This reminds me of another term, preliminary support, which literally means a little buying before the selling climax, which indicates demand. Again, it's not needed. I have never used it, not once in my analysis, and I have traded hundreds of Wyckoffean accumulation areas to include smaller time frames like 5 minute, 10 minute, 15 minute time frames. It's just not helpful for my analysis. It doesn't offer anything of value. We do have a couple of examples for today that I will highlight so you make you aware of the concept, and it's up to you to if you would like to include it in your analysis when you're trading or not. I mean, if say this is LPS and then we will then come down and this was preliminary support, how does that help us? All this is the action. This is a selling climax, the automatic rally, the secondary test. All this helps. Why? Well, because the selling climax, which you're structured from, automatic rally is part of the selling climax, as the market needs to do this because of the chunking. Then with the secondary tests, confirms the selling climax and also gives us entries again here. And then LPS doesn't really help. And then the sign of strength, of course, very important, because this is the final piece of the jigsaw where we're ready for markup. Everything else is inconsequential, not needed. Personally, from my trading, but I like to simplify things. Feel free to go on Wikipedia or look at other sources of accumulation, and it's mind-boggling, and most of it is just waffle and not needed. However, what is useful is to draw a buying zone as illustrated. Note that price cannot close under this level, either when it's touched, like here, 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 demand enters. It emerges. It's very simple, yet extremely powerful. We cannot close under this level. Very, very powerful, and it's a good behavior to recognize this action within a market. Buying zones occur frequently across all time frames and should be a very important part of potential trading setups as demand is proving itself time and time and time and time again. And demand zones are a mild form of accumulation. It's creating cause for a move. And just for clarification purposes, we don't need a selling climax or an automatic rally. All we need to recognize is that when we come into an area, buying is established. Buying emerges, or we touch it and buying emerges. And we cannot close under this level. On occasion, you may get one close, but then it's instantly reversed with buying of good quality. And we will be going through buying zones later on in today's session in depth, along with setups. Excellent. And so this concludes accumulation. And I would just like to finish by saying I have stripped accumulation back down to the bare necessities, literally right down to the bones. I feel as if pure Wyckoffean accumulation is very tedious and not needed. We don't need to analyze and dissect it into phases. We just need to recognize the key components. And after you've done 10, after you've recognized 10 accumulation phases, you can do this yourself very, very comfortably. And it doesn't require a great deal of effort. We don't need to analyze every single phase and every single bar. It's like effort versus result. We put in a lot of work and we don't really gain an edge. The most important part of the accumulation is recognizing the setting climax. And then any rally thereafter, and we've come back down, is an automatic rally. And then the secondary tests, where we hold the setting climax. That's what's of use. Then if we come back down and we get a spring or bag holding or a shakeout that is instantly resolved, we can buy. Alternatively, we wait for sign of strength and then wait for the back up to the edge of the creek setup. Very simple. We don't need to put all our time and effort and energy into the accumulation phase. We have so much more to using price action and the other Wyckoffean principles and VSA principles to get more from the market, to initiate more positions. Okay. There wasn't a graphical representation of the shakeout. Can you? Oh, apologies. Yes, of course. So this is accumulation, and there are two types of shakeouts. One is a terminal shakeout, which happens literally in a trading range or accumulation, or an ordinary shakeout. Now we do cover these in depth, okay, in session 6 or 7, I believe. But as we're here in accumulation, say this bar here came down and we print this wide spread closing week under all this price action and support, and we get good volume. So we think that this bar is continuing south. Okay, even though we can spot its accumulation, there will be other traders who aren't privy, they're not savvy like us, who can understand the process. And you will get a lot of traders, a lot of support and resistance traders, and a lot of bears going short from the break of support. Or there might be stops here. And also it gets rid of weak longs who may have been lucky to get in here and they don't recognize its accumulation. Okay, and this will eradicate all of the weak longs and also induce a bear trap. And this bar we would call a shakeout. It shakes out the weak longs. You can also get it in an uptrend. We have a lovely little uptrend, normal spreads or wide spread, and then a narrow spread, but we continue north. Then all of a sudden, bang, you'll get a bar like this, and then we will continue north as if it didn't happen. All this bar is doing is just shakes out the market before we continue north. It gets rid of weak longs. Good question. It appears there are no further questions. Let's move on to the next study.